Hi everybody, welcome back to another video. Due to the recent macro environments, US office REITs have been badly hit. The huge crash in the share prices, of course, provides shareholders or investors with good opportunities to purchase at the very cheap valuation and with a very high dividend yield. Of course, it comes as a risk if the US REIT do not survive. So let us go through different financial reports and some JLL US report with regards to the US outlook. So in this video, I'll be going through the 3 US office REITs, which is Prime Reit, Keppel Pacific Oak Reit, and Manulife Reit. Before we proceed to their independent reports, I'll actually go through a brief on the JLL US office outlook. For those who are new to this JLL report, it is essentially a report which would analyze about the US offices' performance throughout the years, either monthly or quarterly. I'll put a link down below where you can easily get the report and read through it thoroughly. So for this video, I'll just give a brief important pointers to take from. If we look at the executive summary of this report, US offices leasing has begun to rebound after 3 consecutive quarters of decline. And that's a good thing, with gross leasing volumes growing 11.6% quarter over quarter. However, do take note that all these positive pointers does not really apply to all US offices REITs, because different quality will render different performances. Net absorption rate remains negative but showing signs of inflection. However, it's still not good enough because the US has lost an additional 12.5 million square feet of office occupancy in Q2. Even though the rate of decline is slower, it's still a negative absorption rate. So why is this net absorption rate actually so important for US offices REIT? So let me give you a short explanation on what does it really mean. So if we take a look at this formula, net absorption essentially equals to total space leased minus vacated spaces and minus new spaces. So the total space leased, which will mean customers or tenants getting more space from the REIT. Vacated space would essentially mean that tenants that are withdrawing from the REITs. And lastly, for the new spaces is new offices that are being built. Let me give you an example. So for example, tenant A, B, and C, which has a leasing of 100, 200, and 150 square feet respectively. Let's say on the next quarter, tenant A has actually decided to lease 100 square feet more, whereas for tenant C, he has also requested to lease another 150 square feet more, while tenant B remains the same. So the absorption rate will be 100 plus 150 square feet, which would essentially equates to 250 square feet. Let's say in another situation where the US office is not doing well, and tenant A decided to end their lease while tenant B decided to decrease their office lease or their area of tenancy. So what is the absorption rate? It will be essentially negative 100 minus another 100, which would equate to about negative 200 square feet. So essentially what the report was saying just now about negative 12 million square feet would essentially means that 12 million square feet of office spaces became available. Of course, that 12 million square feet value might also include new offices that are being built up. So we have to continue to see and observe if the trend or the absorption rate continues to improve over time. However, there are also some good news as the JLL report predicts that vacancy rates of US offices might be peak in the near term and begin to decline in 2024. So what are the reasons? It's because 1, slowing volume of deliveries followed by increasing of leasing activities with accelerated demolitions and conversion of older offices into newer REITs. So these factors might actually help to improve the vacancy of US offices over time. Moreover, another good news is that the rental rates surprisingly increased 0.6% quarter over quarter. Even though it's a small amount, but it's still a good prospect or good insight to see. So this report is actually quite interesting, and let me know if you would like me to have a deep dive into this report. Another good news that I feel is transitioning is the companies reducing or removing work from home policies. Tesla, being one of the most productive companies, have been the first one to totally remove work from home, followed by Apple, Microsoft, Alphabet, and other companies which are also reducing work from home policies. With the job market also transitioning into an employer's market instead of an employee's market, I feel that companies would have more power to bring back employees. Employees who do not want to adhere to their policy would be fired and be easily replaced by someone. If you like my content, please support the channel by hitting the like, subscribe, and comment on what other analysis that you would like me to do on. Let's begin analyzing on the REIT's recent performance. So the first US office REIT that I will look at is Keppel Pacific Oak REIT. So looking at their key highlights, net property income came in at 43.9 million for the first half, with NPI surprisingly increasing year over year for better performance from the rest of the properties. Moreover, they also have mentioned that this was inclusive of the disposal of the two Atlanta assets. So this means that the remaining assets are actually performing better than expected. Moreover, their leverage ratio is only at 38.4%, which is a healthy level, far away from the 50% limit. DPU also came in higher than expected. If you watch my previous video, I expected it to come in at 2.4 US cents, whereas for this half, they came in at slightly higher at 2.5 US cents, which we'll see more later. And the leasing continues with 289 square feet being leased out for the first half of 2023. Interest coverage ratio is also at a healthy level of 3.4 times as considered good, considering the cost of debt that all the US REITs are in now. So if we look at their balance sheet, if they are comparing year over year, and for Q2 of 2023 compared to Q2 of 2022, you can see that there are actually quite a few good results, with gross revenue increasing by 4.7%, NPI increasing by 6.8%. Lastly, adjusted NPI also increased by 5%. So, however, because it's not high enough, the distributable income actually dropped by 12.8% and 12.6% respectively. Why? It's because of the interest rate. Because REITs have to pay for the debt interest payment before they can issue to shareholders the income, therefore resulted in a lower distributable income. That's why if you notice, because of the recent great fall in the share prices, the annualized DPU will be a very high value of 16%. So that's why I say that if you are an investor that is very confident with the REITs itself, buying it at certain price or a cheap valuation would definitely give you very good rewards. For their debt structure, it's actually looking quite good, because with 77.6% fixed while 22.4% floating, and on top of that, the inflation is coming down, I feel that the Fed would not have to increase the interest rate as much anymore. Moreover, with their leverage ratio at 38.4% and interest coverage ratio of 3.4 times, it's still quite decent away from the limit. On top of that, if you look at the 2024 debts, it's only required to be refinanced at Q4, whereas for this year onwards, there's only 1.7% that is required to be refinanced, and that can be done with drawing from revolving credits facilities. So throughout this whole year and almost to Q4 next year, that might not be an issue for Keppel Pacific Oak. Of course, it's not all green and good for Keppel Pacific Oak, because their occupancy rate is continuing to drop from 91.9% of last year quarter to 90.8%. And across the board, they are experiencing a slight drop in occupancy throughout all the different buildings except for one building, which is at Houston, Texas. But lease-wise, they have actually renewed about 6.1% of the net lease available, with average lease of 3.6 years. For their rental reversions, it came in at negative 4.6%, but it's because of the Q1 where one of the major tenants have asked for a lower renting price, therefore resulting in an overall decrease in rental reversion. Excluding this tenant, it would have been a positive 4% for the first half and positive 2.6% for Q2. So at least there's some good parts where there's higher rental reversions for different tenants. However, one of the main key components that I feel that why Keppel Pacific Oak is winning over Prime US Reit and Manulife Reit is that their locations of the offices are in areas where it's very attractive for the business to relocate to. So, in my opinion, I feel that in this period of time, Keppel Pacific Oak will still do well. So, in my opinion, with a decent result but a crashing share price in Keppel Pacific Oak Reit, reasonable estimations should be done for the next few quarters. And if you look at this table, for the second half of the financial year 2022 or 2023, if their distributable income worst come to worst drops to 10 million each for each quarter for Q3 and Q4, the declared dividend will be estimated to be about $19.20 per lot. But at this attractive share price of only 22 cents USD, it will annualize to be about 17.4%. So this is something to take note that if you are confident with certain REITs and because of the crashing share price, usually this kind of big difference is due to very negative market sentiment. And that can be seen from the recent effects by Manulife. So let us conclude on Keppel US Reit risk and reward. For the risk, of course, the first priority will be the continued negative rental reversions from their tenants, which will result in lower dividend yield and have a continuation of a negative net absorption, which means that there are lesser tenants occupying their office spaces. However, the reward will be, of course, very high dividend yield and capital gain in the near future. Moreover, I expect the US to start cutting rate when it comes to 2024, when inflation starts going down more. And the last reward would definitely be the opposite, which is the improvement in their absorption rate. Thank you so much for watching. I hope you enjoyed this video because it was getting longer and longer. I had to cut it short. In my second half of this video, I'll elaborate more on Prime US Reit and Manulife Reit. I hope it had provided some decent insights for you. Please hit the like, subscribe, and comment on what do you think about the recent US REITs share prices.